All right, this video is for Module 25, and we're going to talk about bank regulations, and we'll talk about T accounts and how banks create money. So first of all, banks and money creation. This picture, anybody know that picture? This, if you you may remember it from, may have a Christmas song stuck in your head suddenly. This is from the movie It's a Wonderful Life. This guy right here, this is George Bailey. He is the main character. This is actually illustrating a bank run. And so generally what happened is that the interesting thing was that by the time this happened supposedly in the 1930s during the Great Depression, but by this point in time the Federal Reserve was around for quite a number of years. And so one would think, if you know what the function of the Federal Reserve is that these kinds of things would not be very scary. But there's a couple of things that led up to this, and I use this picture as an illustration because this is generally what happened. And so, you know, George Bailey was going to be leaving. The premise of this particular scene was that he was going to be leaving on his honeymoon, and he stopped because he saw this big old crowd at his bank. So he goes in there, and all of these people are demanding their money. And what happened was that George looks at him and he says, I don't have it. He's like, it's in your bank, and it's in your house, and your house, and your house. And he said, I don't have it, because what banks do is they only keep a portion of what you deposit in there. So they're only keeping a small section of it, and then they loan the rest out. And what happened in the Great Depression was that we had a lot of people that were still farmers at the time, and they needed loans to be able to plant next year's crop. And then when the crop came due, they would sell it and they'd be able to pay off the loan. Well, what else was the Great Depression known for? It's also called the Dust Bowl, especially in the Midwest. It was a huge drought period, and so there wasn't a whole lot of crops. And so as a result, all these farmers were defaulting on their loans because they had a bad number of years where crops weren't good. They couldn't pay off their loan. So all of a sudden, they're going and defaulting on their loan. Well, people like George Bailey will go and, you know, try and repossess what they can, but those farmers don't have a whole lot. So all of a sudden, people get concerned for whatever reason about their bank, the security of their bank, and they come in here and they say, oh, I want my money. And George says, I don't have it. He's like, you know Bob over there. He works hard. He's trying to pay off his loan, but times are tough. What am I supposed to do? I'm sorry, I don't have it. Now, spoiler alert if you haven't seen it. For George Bailey, in his case, what he did was that he literally took the money that he had in a cash envelope for his honeymoon, and he asked them, okay, what do you need? What do you need to get by? And he gave out money from his own private savings to be able to get by. And in the end, he closed that day with, I think, $2 left to his name. But that's what happened with bank runs. And as a result, there was a lot of things that came out of the Great Depression that basically put some banking regulations in place. Now, we'll talk about the Fed a little bit later as far as what the Fed does. And the Fed was around during the Depression, but they couldn't keep up. And one of the biggest things that came out of the Great Depression was the FDIC. The FDIC is the Federal Deposit Insurance Corporation. And I don't remember how much it insured people's money at the time when it was originally started. I'd have to look that up. I don't off the top of my head. But for a very long time, more recently, it was $100,000. And then during President Obama's term in office, somewhere there, he upped it to $250,000. And if you noticed in one of your homework assignments, the question I had asked was, and I had said something about, in 2010, 158 banks closed. I wasn't kidding on that, by the way. That is a real number. Okay, 2010 and more recently, those years were particularly bad for banks, and there was a lot of bank closures. But because of the FDIC, they insure depositors' monies of what they have in the deposit in there, as well as the CDs. My CDs went on the other line. So certificates of deposit, if you have money up to $250,000, your money is safe, meaning the government will make sure you get your money back. Does that mean that they saved the bank? No. It means you get your money back. So the FDIC is one of the biggest things that came out of the Great Depression and gave people a lot of security. Okay, I was teaching during the 2008, 2009, 2010 period, and I really did have kids that came in and were really concerned about what was going on in the economy at the time. And they said, "Oh my gosh, what do I do? Should I take my money out of my bank?" And I looked at them and I said, "Do you have over $250,000?" And they said, "No." I'm like, "Then don't worry about it." Okay, but the next time you go in your bank, look for this little plaque. They usually have a plaque that says FDIC, and it says insured up to $250,000 and blah, blah, blah. The next time you're in the bank, it's usually next to the bank teller window. Look for that plaque. You can say, "Hey, I know what that means." All right, so that's one of the things that came out. Also, banks are now must have bank capital. This is basically the idea that banks have to have more assets than deposits. Currently, the rule is 7% the value of assets. So they have to have basically more cash than they have in liabilities. When we take a look at your T count in a little bit, you will find that this may not necessarily be the case in some of the examples that we use, but know that that's what it is in reality. Okay, we also have reserve requirements. Reserve requirements are basically this idea that there is a set reserve ratio. What this means is that the bank is required to hold so much of every single deposit in their bank. Now, it used to be literally that was like cash in hand. Literally, there was cash in the back in the vault. Nowadays, it's numbers in a computer someplace. It's not literally cash in the vault. So keep in mind that currently it is 10%. It's been 10% for a very long time. Very, very rarely does the Fed change the reserve ratio, the reserve requirement. However, for the AP test, they will give you examples where they do change the reserve requirement because they want you to be able to see how that affects the money supply. But do know that, for example, if we deposit $10,000 into a bank, okay, if we're going with a reserve ratio of 10%, that means the bank has to keep $1,000 of it. So $1,000 of it is the required reserves. The $9,000 is going to be the excess reserves. $9,000 is what the bank can then use to loan out to other customers and to the general public. The other regulation that helps prevent against bank failure is the discount window. And the discount window is the rate at which banks can borrow money from the Federal Reserve. This was in existence during the Great Depression, so you literally can get money from the Federal Reserve to the bank. However, there was a bunch of reasons why there's a lot of banks that didn't do this. Number one, oftentimes bank runs are like a flash mob. You can't really see it coming until it's there, and so sometimes it's too late. Number two, the other part of the problem is that keep in mind that borrowing from the Federal Reserve has a stigma attached to it. And so what happens is that people hear that you're borrowing from the Federal Reserve, and they're like, "What's wrong? What's wrong with your bank? You can't keep track of your own finances. Why should I give my money to you?" That's the problem with the discount window. A lot of banks don't want to borrow from the Federal Reserve because there's that stigma attached to it. So rather than doing that, when we get into monetary policy, we'll talk about that there's another alternative. They could borrow from each other. Okay? So for example, if my bank has this excess reserves of $9,000 and your bank is short and your bank needs some money, you can come borrow from me. And I will charge you an interest rate called the federal funds rate. And that is one thing that I could do instead of the discount window. Okay, so these are some of the regulations that try and prevent basically from another bank run or bank closure from happening. So let's go through a couple of examples of how money is actually created. So I did this example in class, so bear with me here. We're going to try and do it on a video. So I had everybody copy this chart in your notebook, and I also said to explain each transaction using a different color. Now, mind you, I only have room on this slide for 2 rows. You may need more rows. So as I change colors, you may need to change colors as well. So I'm going to kind of write through the steps, and so you can write in the steps too. So we're going to start with, this is what I started with in class, is that we had a student that deposited $200 into my bank. So I'm putting $200 into my bank. So that is a liability for my bank because they're putting it, the student is putting it into my bank. So in one class it was Henry. So we'll say Henry puts $200 into my bank. That's a liability for my bank because that's not my bank's money. That's Henry's money. My bank is just holding it for him. So we owe that to Henry, so it's a liability. Okay. However, it's also going to be reserves for us because there's some of it that I can use to be able to loan out to other banks. Okay. So nice and balanced there. Now, step 2 is that, notice I've changed colors now, I'm going to keep the required reserves and I'm going to loan out the extra. Now notice in the instructions that I said that the required reserve ratio is 10%. So I'm going to say 10% of this the bank has to keep, and the rest of it we're going to loan out. So 10% of that $200, so 10% of 200, $20. So we're going to reduce our reserves to $20, and we're going to loan out the rest. So our loans becomes an asset of $180. So the reason the loans is an asset is because of the fact that that money that is going to be paid, that somebody owes to the bank, they're going to have to pay that back. Okay? So loans are going to equal $180. So somebody is going to get a loan, and so we'll say Paige gets a loan of $180. Okay? So Henry deposited $200. We keep 20 of it. We loan the rest to Paige. So Paige gets $180. Paige is going to go and spend it. Maybe she goes and buys something from Cecilia. So Cecilia is going to get that money, and what is she going to do with it? Well, she's going to go put it in the bank. We'll assume that she puts it in our bank. So she's going to then go, and the loan is going to become Cecilia's income, and she's going to deposit it in the bank. So now all of a sudden our deposit changes, and our deposit changes to $380. Okay, because we're taking Cecilia's $180 that she put in plus $200 from Henry's initial deposit. That gives us $380. Now, what happened to the money supply? Remember, the money supply is going to be how much checkable deposits we have and how much actual cash in circulation we have. Okay, the minute my bank made a loan to Paige for $180, boom, it created money. It's like magic. Okay, so it didn't require for Cecilia that gets paid to put it back into the bank because it is money that's in circulation. So even if, for example, Paige takes out a loan for $180 and she sits on it and she does nothing with it, it's still increasing the money supply. $180 has now just been created. But what we did here is that we had $180 got spent, the next person goes and deposits in the bank. Well, now we have $380. So now our reserves change. So now our reserves are $400 because we have $380 plus that $20 that we originally had. So now let's say that the bank keeps the required reserves, and which, by the way, what's the required reserves? If you said $38, you were correct because 10% of our deposits is $38. So we have to keep $38 for sure. Let's say that the bank keeps more than that. So the bank keeps required reserves of $38, and they decide that they're only going to make out a loan of $150. So they're going to loan out $150. So all of a sudden what happens is our reserves goes down to $250, which is way more than I'm required to keep, but I have $250. And let's say I make out a loan for $150, so I'm going to add that to my $180 of loans. So now this becomes $330. So I loan it out to, let's say, Sam over here, that Sam is going to get a loan of $150. Okay? Now, Sam goes and spends it, maybe gives it to Anna, and Anna then goes and takes it. And what does she do with it? She's going to go and become her income, and she's going to deposit back in the bank. And so then our deposits change. So now instead of $380, our deposits become $530. So as you can see, I could keep going with this, right? $530 required to keep 10%. I could loan out the rest, and that would create money. Every time a bank makes a loan, it's creating money. And if you think about it this way, what happens when the loan's repaid? That's right, money is destroyed and the money supply shrinks. All right, In class, I will have an example of this, and I will have you guys walk through the changes, some examples for a T account. I will post the worksheets on Canvas, so you will have that available, so look for that on Canvas under class handouts. Let me know if you have any questions.